Now let's study capital budgeting, one of the most important subjects for the corporate finance. Because the time limitation, we're going to only limit it to the section from 9.1 to 9.4. We only study the traditional discount cash flow method. And without go further into those risk analysis, like a scenario analysis or what if analysis, we'll leave it for other course to take care of it. So basically, we cover the first four sections. In the first section, when you're looking at when you do a capital budgeting, a financial planning, you should include those cash flow are relevant. You're including only cash flow that will only occur if the project is accepted. So that is an incremental cash flow, because additional cost, additional benefit. So the definition is that what is the incremental cash flow? Is the corporate cash flow with the project, then minus the corporate cash flow without the project. A good example is you consider a plan to expand your business. You add one more, let's say one more shop, for example, to a restaurant chain. So would that impact the additional investment and the additional revenue justified? You have to compare with those additional shop and without those shop. Here's a list of certain costs, certain should be included or should not be included. If the cost is already spent, no matter you do this project or not, those we call the sunken cost. A good example is you hire a third-party research department to the company to study if you should do a market study, for example. Cost you, let's say, $25,000. Now, no matter what the result is, that money already spent. You should not include it in your capital budgeting, in your financial planning. The other one is the financial cost. For example, the interest payment. If you are using debt to finance your project, the interest payment, it is a cost, but we do not include this cost in our capital budgeting for the reason that we're going to adjust the cost of a capital, you discount rate the cost of a capital using the after-tax, the cost of a debt, as a part of a cost capital. So instead of looking at the interest payment, we adjust the cost of this project. So that's a kind of exceptional reason for to not including the interest payment or any financing cost in your capital budgeting. Then the rest of most of the project should be included. For example, the opportunity cost. Using this, for example, using that piece of land for one purpose. Now, if you're using that land for other purpose, then the opportunity of that land value should be included, including the cash flow they generate originally from that piece of land should be included. On the other hand, the side effect, if this new project will have positive or negative side effect. The negative side effect, people always call it erosion, or people call it cannibalization. The new store will take away the existing store, neighboring store. Now those effects should be included. But the opportunity cost, and particularly the side effect, sometimes is hard to define. But it's definitely is one reason one fact you need to take consideration when you do your capital budgeting, the investment decision. One important item in capital budgeting is the changing of net working capital. What is net working capital? It is the difference between current asset and the current liability. A good example is inventory, for example. If for the new operation you require additional inventory, in that case, the net working capital increase. Then you have more cash tied up by the operation. So increase net working capital, also increase your investment because those are the money tied up by the operation. On the other hand, if you reduce your net working capital, you free up the tie up the cash flow in operation, which actually is a benefit for the corporation. So we will discuss the net working capital changing in the line items of a capital budgeting. Last but not least is tax effect. The tax effect on capital gain when you sell your own machine, etc., will always have big impact on evaluation part. So it makes the calculation a little bit more complicated, but we have to dealing with it. So let me summarize the relevant cash flows. The tax effect, the net working capital are two important aspects in your capital budgeting. And also is the opportunity cost and the side effect. You do not have included any sinking cost and also not the interest payment or the financing cost as your relevant cash flow. The first step to prepare a capital budgeting is you prepare a pro forma statement. A pro forma financial statement is projected future cash flow operations. So we need to looking at the operating cash flow. By definition, the operating cash flow, OCF, is equal to earning before interest and the tax, EBIT, plus depreciation, since depreciation is non-cash expenditure, you add it back, then minus the tax you pay. This is usually the formula people use. Okay? Now, if in your capital budgeting, in your pro forma statement, there is no interest expenditure, you can just looking at the net income, the bottom line net income, which is the after-tax net income. Then you add the depreciation. But this one, the net income plus depreciation, is when there is no interest expense. Now these two should have the same answer if you're using the looking at your financial statement. Let me see this one. Now let's look at one project, a simple project. Let's see what the cash budgeting will look like. This project is called a shark attractant. It's like some kind of attract sharks. You go to fishing, right? Those are cans. Probably the can full of sardine or something. The estimated sales per year is $50,000 cans. The sales price is $4 per can. The cost of those repellent, not a repellent, is the attractants, to the opposite. Attractants are $2.50. Let's assuming this project you are considered to manufacture or even then you can sell it. It's for 3 years. After 3 years, you quit the business. The fixed cost every year is $12,000. The initial equipment cost is $90,000. That means you buy the machines. Now, according to the depreciation, they are using straight line, 3-year, 100% depreciation. Basically, per year, you write off $30,000 to reduce your taxable. So at the end of the year, you write off all the cost for initial equipment. The net working capital increase. Probably you need to buy more raw material like inventory, etc. So the incremental is $20,000 per year. The tax rate is 34%, and the company cost of capital is 20% per year. So given those inputs, now let's prepare a pro forma income statement. First of all, we're looking at the general sales number. That is 50,000 units times $4. You get the number is $200,000. Now the cost of goods, the cost of those cans, those are variable costs, is 2.5 times 50,000 units. You get 125,000. Therefore, your gross profit, 200 minus 125, you have $75,000 as your gross profit. The company fixed cost, including piece of land, let's assuming labors, etc., $12,000 per year. And every year, you also write off the and write off $30,000 as a depreciation. So the gross profit, 75 minus 12 minus 30,000, the EBIT is $33,000. The earning before interest and the tax. Since the company has no tax, so no interest. Sorry, no interest. They must have tax. They pay tax 34%. 33 times 34% equal to 11.22. So the bottom line, net income in this case, according to our performance statement, is $21,780. Now, let's look at the capital requirement for this project. The net working capital every year is $20,000. You need to increase it for every year, starting from year 0 now. Now the fixed asset, the machine, let's assuming the machine, it costs you $90,000 initially, and at the end of the first year, it worth 60 because you write off 30. Those are net fixed asset decline is by the amount of depreciation each year. At the end of the year, you have 0. The value of the machine is 0. You write it off, all written off. So add those numbers, the total investment per year is that along that line. 110,000, 80,000, 50,000, last one, 20,000. This is just net working capital on that year. You don't have any asset left or all wrote off. Those are not market value, those are book value. Now here, we need to prepare the pro forma projected total cash flows. In years 0, 1, 2, 3, the operating cash flow is the 51,780. Now this one can be done using net income plus depreciation, since there is no interest expenditure. So it's the 51,780 through the line, through all 3 years. But at year 0 now, the net working capital, you have increased it by the amount of $20,000. So net working capital increase is a cash outflow. The money tied up. The net working capital is $20,000. It's a cash outflow. Capital spending $90,000 is for the machine. So you add these two lines at time zero now, the total fixed cost, cash flow for fixed cost fixed asset, are negative 110 and 1,000. Oh, here I'm missing 10, but anyway, you understand. That's cash outflow. $110,000 is the net cash outflow for year zero. If you draw the timeline, the initial cash outflow is negative 110,000. Then let's look at cash inflow for year one. Strictly the OCF, operating cash flow. 51,780 for year one, year two. Now for year three, it's 51 and 780 for operating cash flow. But at the end of year three, you liquidate that project and you free that $20,000 tied up by increase your net working capital. So this recovery of the net working capital should add back. You're almost like cash inflow. Now you're freed from, let's say, from inventory, you're freed. So from cash flow point of view, for third year, is 51,780 plus 20,000. The recovery net working capital total amount is 71,780. Now you have the cash flow for this total cash flow for this project, right? If you can draw those lines. Now let's look at the cash flow line on this spreadsheet. Now spreadsheet is really the easy way to do the capital budgeting. So you put those things on. So we have the cash flow. I do have a spreadsheet attached with the slides. You can download it. But here, just saving time, I'm going to just show you here. So the cash outflow, as we did earlier, the cash flow from asset, the first one for time zero is negative 110. Cash inflow one is 51,780 for 2 years. The third year is 71,780, including the recover of net working capital. Then you do your investment analysis. First, you calculate the net present value. The net present value with interest rate at 20%, 25%. You calculate, and remember, when you do the evaluation, net working capital, net present value is equal to MPV, cash flow 1 to 3, parenthesis, plus the initial cash outflow. So the result is $10,000, 647.69 cents. It is positive. So you basically, you accept this project. Now, how do you calculate internal rate of return? Internal return, IRR, if you use the spreadsheet, it's pretty straightforward. You just IRR equal to IRR, and starting from cash flow 0 up to cash flow 3. The cost is 95.76. So if the cost is 20, then you also accept it. So both is a positive for this project. Now, you can use your financial calculator to do the net present value and internal rate of return. Here is the key inputs. Using CF key, first you have clear all the work, clear the register, right? Then you key that in. The first is negative 11000. Move down. You key in 517 A0. Now here they're using frequency equal to 2 because the CF1, CF2 are the same, 2. Then the CF02, then you have one is the CF3, 717A0. Now, given those inputs, you move to next key, MPV. When first time MPV, they ask you what is the interest rate, you enter 20. Then move down with the error, you compute MPV. The MPV is 10647.69. Now move to next key on your financial calculator. There is a key next to the MPV is the IRR key. Punch that key. Calculate for internal rate of return, which is 25.76. Since the cost is 20, then you accept this project. Now this is using the TI BA2 plus financial key, cash flow key to calculate. But for capital budgeting, I really think you should using spreadsheets. Okay? Using spreadsheet, how do you use using the MPV formula and IRR formula? And remember, how do you do that? I already discussed it earlier, so I'm not going to do it. Should we accept this project? Answer is yes, because MPV is a positive, and the IRR is